Ever found yourself questioning if now's the right time to invest, or if you should wait until 2025? The financial world can feel like a high-stakes game where timing is everything. But what if I told you that waiting might not be the best strategy? Today, on No Noni, we'll dive into whether you should invest now or hold off until 2025. Let's break down the factors that could make a difference in your investment journey and uncover why timing might not be as crucial as you think. Understanding market timing.
Picture this: a roller coaster, thrilling highs, terrifying lows, and the adrenaline rush of not knowing what's next. Now that's the stock market for you. The key to a smooth ride? Market timing. Many think market timing is about predicting these highs and lows, but that's a misconception. It's about observing trends, understanding economic indicators, and making informed decisions. Remember, even the best investors don't always get it right. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." So, patience is key. Don't let fear or greed drive your decisions. Stay informed, stay patient, and let the market do its thing. After all, it's not about timing the market, but time in the market that counts.
The idea of market timing, deciding when to buy or sell investments to maximize returns, can seem like the golden ticket to wealth. But in reality, it's often a gamble. The stock market is notoriously unpredictable, with fluctuations happening every second. For instance, the total market value of all listed companies is around $112 trillion USD. To put that into perspective, it's like every person in the UK paying 129 years of taxes to the government. With such vast amounts of money moving around, it's no wonder that markets fluctuate. Historical data shows that between 1996 and 2016, the chances of a positive day in the stock market were roughly 53.3%, and a negative day were 46.7%. This kind of volatility can make short-term investing seem risky. The long-term perspective.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
When considering whether to invest now or wait until 2025, it's crucial to adopt a long-term perspective. History shows that markets can be unpredictable in the short term, with fluctuations happening daily. For example, the stock market might experience highs and lows over a single year, but if you look at longer periods, such as 5, 10, or even 20 years, the trend tends to be much more favorable. Over the past 94 years, the S&P 500, a benchmark for U.S. stocks, has shown consistent growth. In fact, if you had invested in the market during various crises, like the dot-com bubble or the 2008 financial crash, and stayed invested, you would have seen your investment grow significantly. This is because the market generally trends upwards over the long run, despite short-term volatility. By investing with a long-term horizon, you give your money the chance to grow through compounding returns and recover from market dips. So, waiting for the perfect time to invest might only delay the benefits of long-term growth. In essence, the key to successful investing is not trying to time the market perfectly, but staying invested and allowing time to work in your favor. By focusing on the long term, you can ride out market fluctuations and potentially reap the rewards of market upswings. The power of dollar cost averaging. One effective strategy to navigate the uncertainty of investing is dollar cost averaging, DCA. This approach involves investing a fixed amount of money into a specific investment at regular intervals, regardless of the market conditions. For instance, instead of investing a lump sum of $1,000 all at once, you might invest $100 every month. The primary advantage of DCA is that it helps reduce the impact of market volatility. By spreading out your investments, you buy more shares when prices are low and fewer shares when prices are high. This strategy averages out the cost of your investments over time, minimizing the risk of making a large investment at a market peak. DCA also helps investors stay disciplined and consistent. Instead of being swayed by market swings or trying to time the market perfectly, you stick to a regular investment schedule. This can be particularly beneficial in volatile markets or for those who might be anxious about making large investments all at once. Over time, DCA can lead to significant growth, as it allows you to steadily build your investment portfolio while mitigating the risks associated with market timing. Inflation and its impact. Inflation is an important factor to consider when deciding whether to invest now or wait until 2025. Inflation represents the increase in the cost of goods and services over time, which erodes the purchasing power of your money. In other words, as inflation rises, each dollar buys less than it did in the past. For investors, inflation can be both a challenge and an opportunity. On one hand, rising inflation can lead to higher prices and potentially lower real returns on investments if those returns do not outpace inflation. On the other hand, investing can be a way to hedge against inflation. As prices rise, the value of assets like stocks and real estate often increases as well, potentially preserving or growing your wealth. Over time, investments such as stocks have historically outperformed inflation. Companies can pass higher costs on to consumers, potentially increasing their revenues and profits, which can drive up stock prices. Therefore, investing now, rather than waiting, can help protect your wealth from inflation's erosive effects. By investing early and allowing your money to grow, you may be better positioned to beat inflation and achieve your financial goals. The magic of compound interest.
Compounding occurs when you invest your money and earn interest not only on your initial investment, but also on the interest it generates over time. That means your money grows faster and faster as the interest snowballs. The key is reinvestment.
Albert Einstein famously called compound interest the eighth wonder of the world. This concept explains how your investments can grow exponentially over time. Even with modest monthly contributions, the power of compounding can lead to significant wealth accumulation. For example, if you invest $200 a month with an average annual return of 7%, compounded over 40 years, you could end up with over $750,000. The longer you invest, the more your money grows due to compound interest. Even if you start with a small amount, like $400, and invest consistently, your wealth can grow substantially. The importance of time horizon. When it comes to investing, your time horizon, the period you plan to hold an investment before needing to access it, is crucial. A longer time horizon generally means more potential for your investments to grow. This is because the power of compounding returns and the ability to ride out market fluctuations increase over time. For instance, a 20-year-old who starts investing with a 40-year horizon can accumulate much more wealth compared to someone who begins at 40 with just 20 years until retirement. The extra time allows for more consistent growth, reduces the impact of short-term market volatility, and leverages compound interest. So, the earlier you start investing and the longer you let your money work for you, the greater your financial future can be. In short, patience and a long-term perspective are key to maximizing your investment success. The takeaway: invest now or wait. So, should you invest now or wait until 2025? The evidence suggests that waiting might not be necessary. The stock market's long-term growth trends, combined with the benefits of regular investing and compound interest, indicate that starting now is often better than delaying. If you're worried about timing, remember that investing consistently over time and staying invested through market ups and downs is more important than trying to pick the perfect moment to invest. The key is to start now and stay committed to your investment plan. In summary, the best time to invest is often sooner rather than later. Market fluctuations are inevitable, but with a long-term perspective and a disciplined approach, you can navigate these challenges and build wealth over time. Don't let the fear of making a mistake hold you back. Start investing now and let the power of compound interest and market growth work in your favor. If you found this video helpful, please give it a thumbs up and subscribe to our channel, No Money, for more insights and tips on investing. Thanks for watching, and we'll see you in the next video.